we think it's going to be possible to get the £2 million allowance by using interspousal transfers if it's necessary to equalise up between spouses if assets are distributed unevenly between the spouses. There isn't going to be a one size fits all for clients, and that's, in my view, generally the case. But there are going to be helpful tips that fall into different bands for different values of assets, where farms and businesses are worth less than £2 million. And in those cases, the planning will be relatively straightforward. Where the farm or business is worth between £2 and £3 million, where the maximisation of the nil rated band of £1 million will be important to maximise. And for farms and businesses worth more than £3 million combined, where the planning will need to be more complex. Next slide, please. Simon, over to you with the diagrams.
Thank you, Ruth. Yes, as Ruth mentioned, it might be helpful to think about the impact of these changes according to the different valuations of farms and businesses. And I think the simplest case is going to be that where you've got a farm or a business that's worth less than £2 million. The advice that we were giving to clients before the budget is that you needed a combination of gifts to your children and gifts to your spouse in order to take advantage of both parties, in order for both parties to take advantage of their own £1 million allowance. What this change does is it means that you can postpone gifting to children really until the second death. So you don't need to start making gifts to your children before on the event of the first death. So just to give some examples of how this will work in practice, let's take the example of Alan, who dies in 2027. And at the point of his death, he's got a farm worth £1.7 million, which he's going to leave to his children. And let's say that Alan is the second spouse to die, because Alan had a wife, Brenda, who died in 2018. Now, the way these rules are likely to work is that when Brenda died in 2018, she is treated as making a £1 million transfer. It transferred her £1 million allowance to Alan, so that when Alan dies in 2027, his death estate includes both Brenda's unused £1 million allowance and his own personal £1 million allowance. So in his death estate, you have £2 million of APRBPR allowance. And because the value of the farm in this case is below that value, then the entire value of the farm is reduced to nil for IHT purposes. So he can then pass on the full farm to the children without paying any inheritance tax on it. Before the budget, people like Alan were being advised to make lifetime gifts to his children to really get the value of the farm down to 1 million, because that's the only allowance that he would have. But because he would now benefit from the unused allowance of his spouse, that's no longer necessary. So effectively, you can postpone the transfer really until the second death. And you can also see this in the converse situation, where the person who owns the farm or the business is the first to die and they're survived by their spouse. So in this situation, let's say that Alan dies in 2026. And again, he's got the farm worth £1.7 million. What he can now do is transfer that entire farm to his wife, Brenda, in his will. And because that transfer will be exempt, he will not have used any part of his own £1 million allowance. So his £1 million allowance is unused at the time of his death, so that when Brenda dies 2 years later, her estate again has £2 million of allowance in it. So she can now pass the full value of the farm on to the children. Now, you might want to do something that's more complex here and ensure the transfer to the children. So I think it'd be fine for Alan not to make an outright gift to Brenda. He could, for instance, leave an interest in possession to Brenda in the farm. And that might be a flexible one, but in any case, it would ensure that the farm passes to the children. And it will do so tax-free because, as we said, Brenda has a full £2 million allowance. So where you've got business or farms below that £2 million threshold, I think passing it on to the next generation is now relatively straightforward, you can simply do it on the second death of the spouses. So when that happens, where you have clients who have an asset in their estate that qualifies for business or agricultural relief, and it's below that £2 million threshold, again, with the caveat that every case is different and there's no generalized advice. But I think what most clients will be thinking to do is to execute a relatively simple will that provides that if they are survived by their spouse, that they should be looking to pass their business or APR asset to that surviving spouse. And they could do it outright, or they could do it on a flexible interest and possession trust with remainder over to the children. Um, if they're not survived by the spouse, so if they themselves are the surviving spouse, that means that their estate should have a full £2 million allowance. And that means that they can then just simply pass the business or the farm on to their children outright and free of inheritance tax. So I think a simple will be appropriate when you've got clients with fairly low value farms or businesses in their estate. There's a couple of other planning points to note. The first is quite a positive one, which is to say that sometimes people are concerned that if they're passing their business or their farm to their spouse, how long does their spouse need to own it before they can pass it on to their children, either by making a lifetime gift or on the surviving spouse's subsequent death? Well, the helpful thing here is this. When you're looking at the minimum ownership period ownership requirements for farms and businesses, which are generally speaking 2 years, or if it's a farm that you're not personally farming, it's 7 years, where you've got transfers between spouses on death, you can aggregate the periods of time. So in our previous example, where Alan had passed his farm to Brenda, Brenda doesn't need to own the farm for a full 7 years in order to get APR on her own death, because she can aggregate her own ownership period with that of Alan's. So it's not as though once it's passed the surviving spouse that the 7 year clock starts ticking again. You can add up the ownership periods, which is quite helpful. The other point to note is quite a technical one about drafting these wills, which is that I think, broadly speaking, you should avoid gifting APR or BPR assets as part of the residue to your spouse. So if a client is going to adopt a will such as this, where they simply pass everything, their business or their farm, to their surviving spouse, I wouldn't do that by way of a general residuary gift. And the reason for that is that if an APR or BPR asset goes into the residue, that relief will not simply be allocated to the residuary gift. Rather, it will be spread across the entire estate. So some of that relief will be allocated to pecuniary legacies or specific bequests in the will. And that might interfere with your planning then, because it would mean that actually you've used part of your £1 million allowance if spreading relief applies. So the best way to avoid spreading relief is to include a specific gift of your APR or BPR assets. So have a specific legacy where you're giving your farm or your business to your spouse. And that will mean that the relief will be allocated to that specific legacy. And that will ensure that none of the relief is really utilized upon the first death and is then preserved for the second death.
Simon, when you're
Yeah.
drafting those kind of gifts, do you tend to make specific legacies of the particular assets that you think are going to qualify for APR or BPR, or do you tend to draft it by reference to the assets that happen to qualify for APR or BPR at the 100% rate?
So the practice in the past has been to define the property on the condition that it qualifies for APR or BPR. So the classic statement is, I hereby give my fully relievable property or my property that qualifies for relief at any rate. The reason you would do that, though, is that it's because you'd be giving that asset to a chargeable beneficiary. You'd be giving it to a child or a discretionary trust. And so you only wanted it to take effect if it did, in fact, qualify for the relief. Whereas if you're giving a farm or a business to a spouse, you don't really care at that point whether it qualifies for the relief. I mean, you hope it would, but you don't really care because it's going to be exempt anyway. So if you're gifting something to a spouse, I think it is fine to define it by reference, by a description of the business or the farm, rather than whether or not it qualifies for APR or BPR.
And in some ways, that makes the administration of the estate more straightforward because you don't have to worry about any assets at the side that may or may not actually qualify for APR or BPR.
Yeah, I think that's right. And I think it's quite helpful for people drafting these things at the moment because I mean something we might talk about later is I think drafting precedents do need to be, well, if not completely rewritten, I think they need to be changed a great deal. Because I think there's some drafting precedents that just simply don't work according to these under these new rules. So yeah, being able to just sort of describe the farm or the business or your shares in the business and pass them to your spouse is quite an easy solution until we sort of know more about these rules.
Super. Thanks so much, Simon.
Thanks. Uh, Turning to the next band, where you've got a farm or a business in a higher bracket, so it's between £2 or £3 million. The relevance of the £3 million figure here is that when the government announced these changes, one of the things that they did say to try and reassure farmers and business owners is that by combining these reliefs, you should be able to pass on a £3 million business or a £3 million farm tax free. We have had to look at how these new rules will work, and we think that that's broadly correct, although it depends upon uh, what the position is with your own personal nil rate band or your residence nil rate band. But essentially, by combining the £1 million allowance with the transferable £1 million allowance, along with your personal nil rate band, you should be able to pass more than £2 million of business or farm to children tax free. So to illustrate how this will work, let's say that Alan dies in 2027, and this time his farm is worth £2.65 million. Let's also assume that Alan has got his £2 million allowance because his wife has predeceased him. So he's got her allowance and his own. And let's also say that Alan has got a full nil rate band, so his general nil rate band of £325,000. What his IHT return will look like should be something along the following lines. You take the value of the farm, you then deduct your £2 million allowance, and what you're left with then is £650,000 of value. That is then reduced by 50%, which is now the new sort of default rate of relief for APR. So that means the amount of value in the farm that's chargeable to inheritance tax is now reduced to £325,000. And against that £325,000, Alan's executors can apply his nil rate band. So in that way, you can see that even though you're above the £2 million threshold here, actually the entire farm can pass to the children free of tax.
Yes. So if a client has a £2 million allowance and full nil rate band and transferable nil rate band from a spouse, then they can pass a farm or business up to £3.3 million free of IHT. If we looked at the example that Simon just talked us through, and Alan not only had his own nil rate band, but also a transferable nil rate band from a predeceasing spouse, then that ups by another £650,000 the available APR/BPR assets, making a total of £3.3 million. However, that does assume that there are no assets that are not APR or BPRable, and that the estate has a full double nil rate band to play with. It's important to note at this stage that by the time we get to the level of about £3.3 million, the residential nil rate band will be of less utility, because for estates over £2 million, they start to lose their residential nil rate band with taper relief, so that estates worth over £2.7 million can't benefit from the residential nil rate band or transferable residential nil rate band. And it's also notable that residential nil rate band is not likely to assist if your farmhouse is relievable through APR. It is worth noting that the taper relief threshold cuts in immediately at death, so that if so that you can make gifts late in life, including deathbed gifts that will take you below the residential nil rate band taper threshold to benefit from the residential nil rate band if there are residential assets that you can give to directly inherited beneficiaries, so children and grandchildren, lineal descendants. Obviously, it's not ideal to be making deathbed gifts, and there are plenty of reasons to make sure that one does that with care, both from a capacity and undue influence perspective. So if that's what your client wants to do, make sure to, if they are elderly and might lack capacity, to get a doctor to give a capacity assessment, and take care that you are taking fully understood instructions from a client and not their beneficiaries. Simon.
Yeah, and just if I could just add one point on the problem about farmhouses. The combination of this new £1 million relief and its interaction with the residence mill rate band has actually led to a slightly bizarre situation where it might be helpful if farmhouses, in some cases, don't qualify for APR. I think it's left. I think that will be important in cases where you've got a farmer who's unmarried, and the situation there is, let's say they have a farmhouse worth £500,000 and farmland worth £1 million. What you would ideally want to do is to allocate the £1 million allowance solely to your farmland, to leave as much value in the farmhouse as possible, because that would then allow you to utilize your residence mill rate band and your general mill rate band. But you can't actually do that under the current rules, because this £1 million allowance is automatically spread proportionately across all of assets in your estate. So that means that the value of the farmhouse is going to be reduced by this £1 million allowance, and you might not be able to utilize your full residence mill rate band. In effect, you'll lose part of your relief. So there will actually be some cases where it'll be helpful if the farmhouse doesn't qualify for APR, which actually shouldn't be that difficult in lots of cases, particularly where you've got farmers who are retiring but sort of continue to live in the farmhouse, and it's sort of seen to be the hub of operations on the farm. That might not necessarily be a bad thing in cases now, because it would allow you to then allocate the £1 million relief solely to the farmland and allow you to utilize your residence mill rate band on the farmhouse.
Simon, could you just choose not to claim the APR on the farmhouse?
Uh, yeah, it's a good question. Yeah, well, I
Sorry,
mean, I
just
think,
jump questions on you.
yeah, no, I'd have to think about that. I mean, I think the reduction of, well, you do have to, as a matter of fact, have to claim the relief, when you're making your IHT return. But the way the IHT rules is that those assets that qualify for APR or BPR, I think, are automatically reduced in value by the operation of the rules. So I think if a farmhouse does qualify for APR, I think its IHT value is automatically reduced. I'd have to check that, but I think that's the position. So I think that means that you should claim for it on the IHT return. I'd have to check that, but I think that's the position.
Sorry, Simon.
Yeah, that's okay. What about the clients who have farms or businesses that are in excess of £3 million, or more technically £3.3 million? What's the position here? So let's say that Alan now has shares in a private trading company that are worth £10 million, and he dies in 2027 after these new rules have come into effect. Well, regardless of the value of your business or your farm, you will always want to be maximizing your 100% relief. That means trying to get £2 million of relief in your death estate. So Alan's approach is actually going to be quite similar as in the previous cases. So it doesn't really matter if the business is worth £1 million or £10 million. To get £2 million of 100% relief, you should be looking at spousal gifts. So if Alan's wife has predeceased him, then that's good for Alan. Well, from a tax perspective, it's good for Alan because it means that his death estate will automatically get a £2 million allowance. Whereas if Alan is going to be survived by his wife, then again, he should be thinking about gifting the business, or at least gifting part of the business to his wife, so that she can utilize her £1 million allowance. So the approach is pretty much the same as when you have less valuable farms and businesses. The difference here, though, is that your £2 million allowance is not actually going to remove this business out of the IHT bracket. Um, any value in that business above that £2 million threshold is only going to be relieved at 50%. So effectively, you're looking at a tax rate of 20%, which would be significant in this case. So the advice to Alan, again, it will differ with every client, but broadly speaking, I think that the advice that should be given to Alan is that if possible, he should try to carry out some lifetime planning, which Ruth and I are going to talk about in a moment. So he should be looking to gift business assets during his lifetime, either outright to his children or putting them onto discretionary trust. And if he's got any APR or BPR assets remaining in his estate at death, then he should be looking to pass them to his spouse. And that has got a double benefit. One is that his spouse can then utilize their own £1 million allowance, but also the spouse can, during their own lifetime, then carry out some lifetime planning.
So, what are the options for lifetime planning? Outright gifts that will be potentially exempt transfers, transfers into discretionary trusts that are subject to the relevant property regime, or, and my favourite one, the most romantic one, getting married. So when I gave my talk at the Chamber's Trust seminar on APR/BPR changes, I got a question from the audience. They said that they had been in Devon seeing some friends of theirs that were farmers, and they were asked for their professional advice on whether the younger farmers, so the original farmer's son and his wife, should get divorced, and the wife should marry her husband's father. And I thought that would be extremely effective spousal planning. And because spouse relief will allow you to transfer the whole of the property to the spouse who might be much younger, and allow her to make gifts from her interest that she's inherited, which hopefully she will survive by 7 years, bringing them outside the IHT net to her now ex-husband. So spousal planning is definitely a good idea. Widowed farmers may be in a particularly good situation, because it's certainly possible to get up to 3 nil rate bands through, if you've been widowed, getting 2, and then using a nil rate band discretionary trust, and then allowing your new partner to have the 3rd nil rate band. And it is possible that this structure will be used in the transferable £1 million APR/BPR band. We don't know yet, though, because we don't have actual trust, actual legislation yet to see exactly how technically the APR/BPR nil rate band is going to be transferable. So, lifetime planning, Simon. I'm just go into more detail.
Yes, so clients whose farms of business are going to be in excess of £2 or £3 million, where the advice is that they should be looking to pass some of those assets on whilst they're still alive. Well, your options really are either outright gift or transferring them into a trust. Making lifetime gifts are always the most effective means of IHT planning, because provided you survive 7 years from the date of the gift, then the value passed on will be completely outside of the IHT net. It doesn't need to qualify for APR or BPR. You just need to survive for 7 years. Of course, if you do die within 7 years, and I'll look at that in a little bit in relation to the forestalling provisions, then it is helpful if the property continues to benefit from APR or BPR. So the person you're gifting it to should retain it as a farm or as a business, because that will then reduce the inheritance tax if the potentially exempt transfer fails. But yes, standard advice to clients is try and pass some of their farm or the business on whilst they're still young and healthy. You do have to think about other taxes, the main one being capital gains tax. If the asset qualifies for APR or BPR, it will normally get gift relief for capital gains tax purposes. You do have to note here, though, that just because something qualifies for business property relief, it won't automatically get gift relief. The requirements are more stringent. With business property relief, the test is one of wholly or mainly. That basically means that your business needs to be more than 50% trading. The test for gift relief is one of substantially trading, and that's normally interpreted as meaning 80-20. So it needs to sort of be at least 80% trading. So where clients are passing on shares to their children, make sure that the composition of the company is such that it qualifies not just for BPR, but for gift relief for capital gains tax purposes as well. You also need to think about employment-related securities in certain cases. If the children have worked for the company, are you rewarding them for their employment? So could that lead to an income tax charge? Again, that's something you can normally get around, but it is something to think about. And making sure that, if the client is passing on their business to the farm, have they left enough to live on themselves? We've all probably come across cases where somebody has been too generous and has had to dip back into the things that they've gifted away. And that then leads to an unraveling of their tax planning because you then fall into the reservation of benefit rules. So making sure that you've got enough to live on. Gifting was something, a lot of people were probably dealing with this in the run-up to the budget. Someone remarked the other day that there's going to be an awful lot of very rich children in the near future. So this is something that has been going on. And one of the things that people are sometimes concerned about when making outright gifts is that there is an inevitable loss of control over the business of the farm. And that might be why you'd want to favour setting up a discretionary trust, which we'll come on to in a moment. So think about the issues beyond tax if clients are thinking about gifting their business or their farm to their children.
Sorry, is it right that if you end up splitting the ownership, for example, of a farm, that you might get some valuation benefit from that as well when you end up filling out your return?
Yeah, that's right. It's a good point. Thanks, Ruth. Because when these rules were coming into effect before we had draft legislation, I think most people assumed that there'd be anti-fragmentation rules. So that, if you ended up dividing the farm into 5 different trusts, you would look at the value of the farm as a whole, as happens in other parts of inheritance tax. That hasn't happened. I think it's section 161, which has got the anti-fragmentation rule. The current draft legislation doesn't import that into these new rules on APR or BPR. So actually, if you've got a particularly valuable business or farm, there would be a benefit to splitting it up into smaller parts, at least for tax purposes, because the market value of an 80% shareholding is not going to be the same as the market value of 40% shareholdings in a business. And without an anti-fragmentation rule, you can then, for valuation purposes, say that the value of these individual components is less than the whole value. So I think that is going to be something that we're going to see a lot of.
Yeah, and just to comment on the point about the old rules applying so that gifts before 30th of October 2024 benefit from 100% relief if the pet fails. I did a lot of planning in relation to the Court of Protection before the last budget, and it was actually really interesting to see how quickly the Court of Protection were able to deal with those tax motivated giving to give effect to them before the budget last year. I was quite impressed.
Sorry, these rules, they don't come into effect until 6th of April 2026. That said, there is a forestalling measure. So if you make a gift, any gifts made from after the 29th of October 2024, if you die within 7 years and after the new rules have come into effect, you will be caught by the new rules. So it is really important that clients do survive for 7 years if they've decided to go down this route. Discretionary trust. I mean, the point I mentioned in the last slide, people don't like sometimes making outright gifts to their children because you do lose control over the business of the farm. And often with clients with that concern, it's more attractive to put the business of the farm into a discretionary trust because there, I mean, if you've got shares in the business, those voting rights will vest in the trustees, and the person making the gift can be one of those trustees. So it does allow you to retain control, although of course, you do have to exercise that control for the benefit of your children or whoever the beneficiaries are of the trust. It's got benefits beyond that, particularly if you're concerned about your children going through a divorce or their profligacy. Having something in a discretionary trust allows some degree of protection against those events. Putting assets into a trust, there is an important planning opportunity now. You can do this with 100% APR or BPR relief, which is unlimited, as long as the assets go into the trust before the 6th of April 2026. After that date, when assets go into a discretionary trust, the first £1 million will be relieved at 100%, but after that, any value in excess of that is only going to be relieved at 50%. So in effect, there's going to be a 20% or sorry, a 10% charge on assets going into a discretionary trust above the £1 million threshold after April next year. So this is your last chance to put a significant business or a significant farm into a trust completely tax-free. It should also be free from capital gains tax purposes. You'll get another form of holdover relief. Of course, you've got to make sure that that trust is not settler interested. So the settler can't benefit from it, nor can their spouse or minor children. But provided that you satisfy those requirements, there shouldn't be any CGT when you put those assets into the trust. Once it's into the trust, you will then have to plan for relevant property charges. So there will be 10-year and exit charges on the trust, which is going to be a new thing for business owners and farmers to get their head around. They have been used in the past to having these significant assets in trust without worrying about relevant property charges. That won't be the case anymore. If the business of the farm is over £1 million, then it's going to be relieved at 50%. What that effectively means is that there's going to be a 3% charge every 10 years on that excess value. So it's going to be a good practice to start reserving, well, about 0.3 or 0.2% of the value of the business of the farm every year, in planning for that 10-year charge. And with relevant property charges, the instalment option will be available. So you will effectively be able to pay 0.3% of the value of the farm or the business every year following the first 10-year charge, which will help with liquidity issues. Now, I mean, people generally they don't like relevant property charges. I think what I've been telling clients is that depending on what stage of life you're at, having a 3% charge every 10 years is better than the risk of a 20% charge if the business owner or the farmer unexpectedly dies. But it really depends at what stage of life you're at. If you're a young and healthy farmer or business owner, you might want to keep things just simply owned outright by yourself. And then finally, just some other issues to be mindful of with planning, particularly if clients are thinking about lifetime planning. There still continues to be problems with the trust allowance. So as Ruth mentioned at the beginning, there are two separate allowances under these new rules. An individual has their own allowance, which recharges every 7 years, but there is a one-time trust allowance. So if you put £1 million of BPR assets into a trust today, you will have utilised that trust allowance. So if in 10 years' time you set up another trust with £1 million of BPR assets, that second trust won't have its own £1 million allowance. So it's a one-time allowance. Once you've used it, it will be gone forever. And it will operate in quite an inflexible way. Effectively, it's the amount of allowance that trust has is fixed by the amount of APR or BPR assets that go into the trust at the beginning. So if you put £1 million of BPR assets into a trust today, that trust is then stuck with that £1 million allowance. So if that trust subsequently sells the BPR assets or the APR assets and it's replaced with cash or investments, you will have effectively lost that trust allowance and you can't reallocate it to any other trust that you might have set up, which might be holding APR or BPR assets. So it's going to be a good idea for lots of clients to set up trust before April next year. But if they are going to do that, they do need to think about the long-term plans for that trust. I mean, it is quite common for people to set up a trust of their business prior to an exit from that business, with the plan being that they're going to sell the business and replace that trust with cash. And that might still be a good idea for clients, but I think you need to warn them that they will have effectively lost their trust allowance and they won't be able to get it back in the future. So thinking in the long term about how that trust allowance is going to be utilized. Clients should also think about how they deal with their what are now going to be called pre-commencement trusts. So if you had trusts holding BPR or APR assets on the 29th of October 2024, those trusts now have a really favorable status under the new rules. Each of those trusts, regardless of how much value is in them, will automatically have and will always have a £1 million allowance. So they're a really good thing to keep in existence for the time being, and they won't be affected by the new rules until their first 10-year anniversary. So you'll be able to take assets out of those pre-commencement trusts without triggering any IHT charges before their first 10-year anniversary. So if clients are looking to sort of close down any trust that they've got in advance of the new rules coming into effect, it might be worth just reviewing the position and actually thinking about how those trusts have a favorable status under the new rules. My advice usually is that if you've got those trusts in place, keep them in place and review the position before their next 10-year anniversary. There's continuing to be issues about drafting for these things. I think both Ruth and I have spent a lot of time drafting wills and trusts over the last month in the run-up to last week's budget, where we've encountered sort of problems in how you define assets that are going to pass under your will. One piece of advice I've always been giving is that a common formulation that you find in drafting precedents, a gift of my 100% relievable property, I've generally been advising people to avoid that formulation. There's quite a technical reason why I don't think it works anymore. It's to do with the fact that if you've got two separate gifts in your will, each of which contains APR or BPR property. So, for instance, you might have a legacy of one part of your farm and another part of your farm is going into the residue. The 100% relief is going to be automatically shared across each of those gifts. So it can't be allocated to one of them. So there's no amount of property that you can actually put into a specific legacy that will actually get 100% relief. So that there is actually a chance that a gift of 100% relievable property might actually fail in its entirety. So I've been advising people to avoid formulations of that kind. There's quite easy ways to draft around it, but I think people do need to think about their drafting precedents when planning for these things.
Yes, we also need to consider how this change is going to impact with IHT on pensions, as many people will be holding business assets as part of their SIP or SAS pensions. Pensions are going to be subject to IHT essentially for the first time from 6th of April 2027. So that's not next year, but the year after. But we don't expect there to be any APR or BPR relief for assets held in pensions. And so that is also something that needs consideration and is going to be a double whammy. There are some questions and comments in the Q&A box, and if you want to ask some more, you can test the limits of Simon and my ability to answer those questions. The first thing that has been said is from Austin Penfold, who makes a kind of commercial comment, for which thanks very much. He says, one consideration on discretionary trusts from a commercial perspective, which he has found in practice, is whether banking consents are required and whether banks still have an appetite to lend over property, particularly agricultural land held in trust, as this may put further strain on commercial operations of the business. And I think that's right. Like the fragmentation might work from a tax perspective, but from a banking perspective, it might be more difficult depending on who then owns the assets and how confident the banks are in the structure that you've created. Simon, we've also got some questions about the transferable £1 million band. Do you want to have a crack at those?
Yes. So the first question, so in example one, will Brenda be allowed to transfer her £1 million allowance, even if she claimed more APR/BPR than that when she died? So in that first example, we had Brenda who died before any of these rules came into effect in 2018. What the government has announced is that if a spouse has died before the new rules come into effect, so in other words, if they die at any point before the 6th of April 2026, then they will automatically pass a £1 million allowance to their surviving spouse. So yes, even if Brenda had gifted APR or BPR assets on her death or within 7 years of her death, she will nonetheless pass £1 million a £1 million allowance to her surviving spouse. So that is quite helpful. So the next question is, do we know whether the first to die has to own 100% relievable assets to have £1 million allowance that's transferable? Well, the first to die, I think the position is that when the first party dies, they don't have to own any APR or BPR assets at all. The point is, as long as they don't utilize any of their allowance, then that unused allowance will be transferred automatically to their surviving spouse. So again, to go back to the first example, where Brenda has died in 2018, if Brenda never owned a farm or shares in a trading business, so didn't actually have the opportunity to utilize any APR or BPR, then that would mean that she would not have utilized that allowance on her death. So therefore, her allowance is unused and it would pass automatically to her surviving spouse. That I say that with the caveat that we've not had the draft legislation yet, but that's how I read the government's announcement. And I suspect that that's what will happen, because that is the way in which the brought forward allowance works with the residence mill rate band for people who died before 2017. You don't inquire into whether or not they had a residential interest in a property before 2017. You just assume that they had a full one that they could then bring forward to the surviving spouse's estate.
That's what I'd expect too. One question that we've had is that for holding purposes, would a fully discretionary trust in wills with APR and BPR and spouse planning done after death work for dealing with Section 39A issues, obviously respecting the time limitations of Section 144 and 142? It strikes me that that's a relatively good holding position, that there won't be that provided you undertake your planning in time within your 2-year period, you'll be able to get your best result out of post-death planning, so that you understand what all the situation is when you need to make decisions about where to allocate assets. Would you agree with that, Simon?
Yeah, I think that's right. And in fact, that's what I've really been advising people to do. It's actually because of this point about not being able to allocate this £1 million relief to particular gifts. It's actually quite difficult to draft a will in such a way that you're giving your £1 million worth of BPR APR assets to a child and then the residue to the spouse. So what I've been advising people to do is to just have a discretionary trust that captures all of their APR and BPR assets, whether they qualify for 100% relief or 50% relief, and whether or not they include accepted assets. So put all of that into a discretionary trust. And then at the point of death, when the values crystallize, you will know how much you can give to the children without triggering an IHT charge and how much you can then allocate to the spouse. So just make sure that the beneficiary of that discretionary trust include both the children and the spouse. And then you'll have 2 years after death to then sort of rearrange the estate in such a way that you're not paying inheritance tax, at least on the first death of the spouses. And I think,
Oh
sorry.
no, sorry.
No, I think that's the so the question is that is there an easy way to do that, particularly in a way that avoids the apportionment problem with Section 39? I think that is the easy way to do it. So to include, make sure that the discretionary trust is not of the residue, but rather it's a specific settled legacy going into a discretionary trust.
Yes, and that I think is our suggested alternative to a drafting 100% relievable property gifts, isn't it, Simon?
Yes. So are you
There's a
thinking about the
question.
next question?
Yeah,
Yeah.
exactly. The question is, in terms of drafting issues with
Yeah.
the 100% relievable property and the relief not being able to be allocated to specific assets, are there some suggested alternatives? Unfortunately, I think our suggested alternative is a great big discretionary trust.
I think there is a way of drafting around it. I mean, if you've got a client who really wants to give £1 million BPR APR assets to their children and then residue to a spouse, I think you can draft around the problem I mentioned earlier. It would be something along the lines of, making a gift to my children of such value as will not trigger an IHT charge. Something along those lines, I think would do the trick. I take no responsibility for drafting on the hoof, but I think wording along those lines would suit the purpose. I think that is slightly messy though, and I think as Ruth says that the better solution is to have a discretionary trust and then to sort of reallocate things post death.
Yeah, if you do want the benefit of Simon's insurance policy, do feel free to get in touch with the clerks. In terms of there's a final question, Simon, which is
Yeah.
about Section 69. It says that Section 69 will be amended so that all relevant property trust exit charge rates are calculated based on values before APR or BPR, regardless of whether the exit takes place before or after the 10-year anniversary. Does this mean that one should be looking at extracting assets before the 6th of April to avoid an exit charge? I mean, certainly that's a possibility if you want to avoid an exit charge, because it will be fully relievable before then. But that depends who you're going to give the assets to, I think,
Mm.
because if you're going to give them to a young person, it's sort of the opposite problem from the one that Simon was talking about. Are you better off with a 3% charge every 10 years than a 20% charge if someone dies unexpectedly? You might want to avoid your charge on your initial your 10-year charges and your exit charges, but you might actually find that you're better off with the assets in a trust structure than in the hands of your living beneficiaries.
Yeah, and I think that's right. And I think this question is also to do with it was a slight anomaly in the way in which you calculate exit charges. So with the first 10-year charge, you look at the initial value of the property, ignoring APR, BPR. But if stuff comes out of that trust within the first 10 years, as long as the thing that's coming out of the trust is business or agricultural property, there'd be no exit charge. But after the first 10-year charge, the way you calculate the rates is you do include APR or BPR. So that means that the way in which you calculate the rate after the first 10-year anniversary could always be nil, even if the trust held assets that no longer qualified for APR or BPR. That anomaly is now being removed. So if you've got a client who's concerned about that and wants to avoid future exit charges, then yes, taking it out of the trust before April 2026, I think is good advice.
And there's been a question, which is one I actually asked Simon before the webinar, so I'm confident I know the answer. In the slides, we said that up to £3.3 million worth of assets could be given tax-free by a married couple. That figure is made up of £2 million worth of £2 million allowances, plus a double nil rate band of 2 times £650,000 because there's another £650,000 on top that you can add in, which will be charged at 50%, and you can use your double nil rate band to relieve that. So that doesn't include the residential nil rate bands. The residential nil rate bands are not included because they will be tapered away. Hopefully that makes sense.
Yeah, that's right. It's because the 1.3 million pounds above that 2 million pound threshold is not actually 1.3 million pounds. As Ruth says, it gets reduced by 50% to 650,000 pounds. Because that, while relief is going to be restricted, it's not going to be completely restricted. It's just there's going to be a default relief of 50%. So anything above that 1 million pound allowance still gets relief at 50%. The 1.3 million pounds comes down to 650,000 pounds. And then against that, you can apply the double nil rate band.
Yes, but that makes it that only applies if you don't have any estate that isn't relievable, because you won't have any free nil rate band to deal with that.
Yeah.
Do you think that we've answered all the questions, Simon? The
I
questions
think
were
we
very clever,
have done,
weren't they?
yes. Yeah.
Thanks very much for the difficult set of questions, and thanks very much to Simon for suggesting the webinar and for doing all the really technical bits so well.
Thanks, Ruth.
Hope you have a lovely afternoon. Bye-bye.
Thanks. Bye.